Hello my fellow freedom builders, and welcome to a quickly weekly wrap up where I'll try to summarize what has happened over the last week. I will be trying to do this almost every week, but especially the weeks that, like the last one, have been extremely busy and filled with rumors and panic and greed and all sorts of stuff. And I think it was the right time to start this weekly wrap-up video series. So first of all, we have the S&P 500 here. And as you can see, I put a couple of arrows on. I will try to do this from week to week now, but this is you could say a statistical model I have built that is trying to gauge when we will start to see some selling and buying pressure in the market. This is a weekly chart. So as you can see, it hit it quite well here. It said that sellers should be starting to get into the market. This was back in the beginning of February. But as you can see, it's not completely perfect because it said as well that the investors were about to start looking for reasons to buy. And that was the beginning of last week. And then we had this terrible week here. We've actually had a decent week this week, even because of all of this panic we have seen. I'll get to that in a second with the SVB bank and everything. But this doesn't mean that we will necessarily go upwards. It means that we are at a point statistically where a new buying cycle should be starting. However, there can be news that are so dire and panic creating that we can see a sell-off like this. However, it doesn't mean that we necessarily is going to crash, and this is not a complete predictor. But as we can see this week, there are actually buyers ready to buy in the market. So let's have a look at what has happened this week. Because last Friday, we had the NFP numbers, the job numbers from United States. However, people completely forgot about them because we had this SVB incident, and I think you will have heard about this at this point. The big question this week, of course, has been, is this SVB bank, the Silicon Valley Bank or finance, is that the start of a new financial crisis? Well, last weekend I said to my Danish subscribers, I said I am 99.99% certain that Fed and the government United States will come out with some sort of bailout saying people in the bank will not lose their money. Because what is the worst thing that can happen to a bank? That is a bank run. And that was what happened in the SVB bank. They actually had the money in there. They just didn't have the liquidity, and that is the problem with the bank run, that if you put your money in a bank, they don't have it in cash. So when as with the SVB, that the customers panic and they try to withdraw all the money. I think it was something like 25% of all the money that had been deposited in SVB bank were withdrawn within a day or two. There's simply not liquidity there. And then the extra problem with the Silicon Valley Bank was that they had put their money into some longer term bonds to get a better interest rate. So when they were trying to sell, or when they needed the liquidity, they had to sell these bonds. The problem is that the interest rate has gone completely straight upwards for a year or so, and when interest rate goes up, the bond price goes down. So SVB was sitting on a lot of bonds that they could only sell with a loss. The thing with bonds is that if you hold them to maturity, you get you get 100% back for the bonds. That is how they're constructed. But they actually got a kind of a margin call here. They had to get liquidity quickly, which meant that they had to sell with a lot of loss on the book. That was what panicked people. Then, of course, just a few days before, there was this crypto-related bank or crypto-focused bank called Silvergate that also went down. Then we had the SVB, we had the Signature Bank, and then the First Republic also got in problem. And people were starting to panic. And we also saw it spread to Europe, where the Credit Suisse, the large bank in Switzerland, also got under pressure. But every time, until now at least, we have had governments, central banks and so on stepping in saying, don't worry, we'll cover, and there's no need for a bank run. And I've been saying the last week that as far as I can tell, and I'm not a 100% expert here, and I'm not an economist, but as far as I can tell, the large banks in the world are significantly better equipped to handle a crisis today than they were in 2007, 2008. I found this article here. Silicon Valley Bank's collapse isn't a Lehman moment, at least not yet. Of course, the pressure can be so severe on the banking sector, and the interbank interest rate can go up so much that we start to see the interbank market simply freeze over as it did under the financial crisis in 2007, 8 and 9. But as of right now, I don't see this coming, and that is what the market is also telling us, at least up until now. We can have this on a daily chart, and we can see that it has actually been a decent week every time there's been, for instance, the Credit Suisse, things dropped, but then we got reassurance from the SNB, the central bank in Switzerland, that they would cover, and then everything was kind of fine again. We can see the market are not completely green, but they are also not in panic mode right now. All right. A question I have been writing and talking about a lot this week is then, of course, is it okay for the banks to get bailed out? That is a huge question. It's good for us right now that the banks are being bailed out, because it means that the stock markets are not dropping anymore, and if you're a customer in such a bank, you can get your money out. That's all well and good. However, there's a big debate to be had as to if these banks are actually making a lot of money on taking huge risks, knowing that if the risk doesn't pay off, if they're getting punished, then there'll be a government or central bank bailing them out. And there are a lot of debate right now as if bankers should be punished more for crashing a bank in instances like this. But, well, you can put in the comment section below what you think. I actually think there is a point to the fact that having banks that are so significant importance in our society, just taking risks that can collapse the entire economy of the world, I think we should have some sort of extra control here. And as we can see, one of the reasons why the SVB and First Republic and so on, the reason for the crash we have seen now is actually that the regulations that were put in place after the financial crisis, the regulations there, they were cancelled in 2018 under the former president. Thought that was a good idea, and that is actually the reason why we've had a bank now with almost $250 billion on the balance sheet that is collapsing. Before, with the regulation, it was only banks under 50 billion, so a fifth of the size, that could actually get into this sort of trouble. But I'll put a link to this below. Some people are saying Silicon Valley is too small of a bank, it's just a regional bank, it cannot cause a financial crisis. That is not really the reason why, and if you want to see that a smaller regional bank can start an avalanche in the financial market, we have here the collapse of Northern Rock 10 years ago. This is an article from 2017, so this was in 2007. We saw a bank run on a bank called Northern Rock here, and that was in the UK, and it actually were kind of the start, kind of the beginning to the entire banking sector problem in the financial crisis some 15 years ago. All right, well, what has happened this week? Let's have a quick look at the calendar here. If we are starting Monday, this week, we saw that President Biden were out speaking, saying, don't worry, nothing to see here. We have the SVB banks and Signature Bank and so on. We have them covered. That was actually very good. So not much more happened there. And even if it had, people would have focused simply on the bank collapse there. Then we came into Tuesday, and that was an important day because right now, one of the reasons why we had the entire banking collapse was that the interest rates are going up so quickly. And well, the Fed have been hiking, and people have debating if they would hike by 50 basis points or 25 basis points next time. So it was important Tuesday to see what will the inflation numbers be. Had they been a lot higher than previous, we would actually probably have seen a crash more on the market, because then Fed would have been forced to hike the rates even more, and we could have seen more banks in dire problems. However, the inflation, the core inflation, was just slightly down, but it was down. And we can see the overall inflation rate. The core inflation is without fuel and without food. You could say that's a bit of a phony CPI, but that is what Fed is mostly looking at. The inflation rate here is what I normally look at. That includes fuel and food, and that went down from 6.4 to 6%. Still extremely high, but it's going in the right direction. We'll have a look at the PPI in a second, because that is indicating that this might be going even lower. So that was Tuesday. Then we had Wednesday here. And we can see we got some industrial production things here, but the really interesting thing was the PPI. The PPI is sort of the inflation for the production for the companies. And what I started to talk about, let's just have a quick look here at the core PPI year over year. What we can see normally is that when the PPI is going upwards, the CPI, the Consumer Price Index, is also going upwards with a bit of delay. That means that when the inflation in the production companies, if that goes up by 9.7% per year, then what do you think they're going to do with that inflation? They're not eating it themselves and cutting the bottom line. They are sending it on to the consumers, and it is being worked into the CPI. So we normally say that the PPI is leading the CPI by 4 to 6 months. And we could see over the summer that the PPI started to turn downwards here last year. And that's when I said, when people were expecting CPI of 20% and 30% and the world is collapsing, I was saying, well, as long as the PPI can keep going down, we will see a beginning sloping down on the CPI as well. I know it's a bit technical. Right now, it is dropping rather quickly, actually. Dropped 0.4, dropped 0.8, now dropped 0.6 year over year, of course. Which means that if we can get this down to a couple of percentage points, and I think that is possible, especially if we run into a recession sometimes this year and next year, this will be pushed even further down, then there will be less and less pressure for building up higher prices on the consumer side as well. So the PPI is definitely something you should have your eyes on if you are interested in this sort of environment. So what else do we have? Not much of interest here. Yesterday, Thursday, if we look at that, there were some building permits that were higher than expected, meaning that people are actually that they feel enough safety to actually starting to build some houses here. We have, of course, the rate decision from ECB, and that went up 0.5%. And yes, I think that was about it. Absolutely. And then we had here today, Friday, we had the inflation numbers from the euro area, and that was actually a bit more severe than in the United States. We can see that the core inflation is going up from 5.3 to 5.6. That is not too good, and we are getting the industrial production from United States also here in a couple of hours or so. So that is the numbers for this week, and what we are basically looking for is, what does this tell us about the pressure on interest rates? And if we're looking at the interest rates here, we can look at on a weekly chart first. I've put a couple of blue areas here. This is actually the most important, and that is if the this is for the US bond market. This is the yield on the bonds, and this area here is if the Fed interest rate is going to be hiked to 5.5%, 5.3 maybe the terminal rate. This is where the shorter term interest rates will be heading. Right now, the last couple of weeks, especially this week, they have been plummeting really hard, and that is of course because of people have been selling out of their stocks. They have been buying the bonds, and also there were some speculations that Fed might start a new QE program simply to put some more money into the banks and into the economy. But right now these are going down. If you're looking at them on a daily, here you can see that they have actually stabilized quite a lot, and maybe even started a bit going upwards here. You can see we have the 6 month year, we have the 2 month, we have the 1 year. So this is a picture of the inverted yield curve that is talked so much about, where all the shorter term yields are a lot higher than the longer term yields. Normally, if you were to tie up your money and take risk for 10 or 20 or 30 years, you would need a lot higher interest rate. But right now we can actually see the shorter term interest rates are a lot higher, meaning that people are more concerned about the near future than the far future of the economy. So my guess is that these will pop a bit up again, and we have the Fed meeting. We can just have a quick look at the FOMC Countdown here, which is a neat tool to have. In here we can see both when the next Fed meeting is, the date here, and we can also see what the market is pricing in, what they think will happen, the percentage likelihood. And this has been all over the place the last month or so due to all of this banking insecurity. But we can see that the rate right now is 4.5 to 4.75%. And they're actually priced in a 20% probability of that staying so when they meet on the 22nd of March here next week. And then there's an 80% probability of 25 basis points upwards. I think as well that this is the most likely. I don't think that unless the banking collapse here had really gone faster down, then they might have just kept it at zero hike. But I think 25 basis point is the right place. So what is happening from here? Well, I still, in my algorithmic model for the US market, I'm still 100% in stocks. We've been so since here in December sometimes. So that is just in stocks. On my normal model, where I invest a bit more discretionary in the US market here, I am actually bullish for the next weeks here. I think we're going up, and I'm leaning on my model here. I'm leaning on the banking sector actually being bailed out, and everything is calming a bit down. I did, however, for the end of June buy a put option. Right now I can't actually recall where I bought it. I think it was something like a strike price of something like it was the ETF SPY. I bought I think it was a strike price around 360. I can check up on that, which means that if the market simply just plummets, this put option will explode in price, and that will pay at least some of my losses back. I have only spent something like 0.8% of my overall capital in this account on this put option. So it's not that I have spent a fortune on it, but if the market really collapsed there, and I bought it back, I think it was back here sometimes, back in beginning of the year maybe, bought a half a year out so that I had some security if the market completely collapsed. Then I have, of course, my option portfolio. I have some iron condors that I put fairly wide out. I think it is something in this area here. I have my iron condors. If you don't know what iron condors and options are, there'll be plenty of videos on that. But an iron condor is a strategy where you make money if a stock or an index stays within the boundaries that you have set. All right, this is actually further down. I am pretty sure it was all the way down here. I was a bit uncertain of where that would go. But I put the iron condor on when the volatility was very high, which means that since it has what is called negative IV, you're making money if the volatility is dropping. And I put it on when the volatility spiked up here. Which means that right now the volatility has dropped quite a lot. which has helped my position quite a lot. But if this sounds like complete gibberish to you, don't worry, I'll make some videos about it, explaining about it. Alright, I think this is all for today. I'm sorry about the, it went into being a bit of a long wrap up here, but there was a lot going on. And normally in the future wrap ups, I will probably be able to do it in 3 to 5 minutes. So sorry for the 20 minutes spent of your life here. Have a nice weekend out there, and I'll be in touch soon. Bye for now.